Let's talk about something that's quietly causing tax trouble for U.S. companies doing business in Canada. Merchant of record services. They promise simplicity. They promise to handle all your sales tax issues, the collections, the payments, the compliance. It's all done for you. Sounds great, right? Well, not so fast. While these services can reduce your operational workload, they also create real tax exposure, especially when you cross borders. So in today's video, I'm going to walk you through what a merchant of record actually does, the hidden traps most CFOs miss, and how you stay compliant if you're using one of these services or considering using one of these services if you're a U.S. company doing business in Canada. But before we get going, let me make it perfectly clear. I am not suggesting in this video that you do not make use of the services of a merchant of record. Quite to the contrary, I encourage it. Just know the limitations of the merchant of record model. That's all I ask. They take your payments, they handle your sales tax, they issue you reports. But once you look under the hood, the story changes a little. Let's break it down. So what is a merchant of record? A merchant of record is a third-party service that processes your customer transactions on your behalf. They collect your money, they handle and remit your sales taxes to the CRA, and send you the payout, minus their fees, of course. They are often marketed as one-click compliance, the end of sales tax headaches, cross-border made simple. And to be fair, they can offer you real value, especially for high-volume digital sellers or startups entering new markets. But here's the problem. Most of them are built for simplicity, not tax strategy. And when you're operating in both Canada and the United States, that simplicity can cost you a lot more than you think. Here's where merchant of record services get very risky across borders. They often trigger cross-border tax consequences that go completely ignored. Here's just a few real-world examples I've seen with some of my clients. Yes, your merchant of record is handling your Canadian sales taxes, but you are still on the hook for the income taxes. You assume as a third party is doing the sales tax collection that you have no presence in Canada, but your Canadian revenues create a taxable presence. Now, these revenues may be exempt under the treaty, but at the first blush, you may have a taxable presence in Canada through the use of a merchant of record. The merchant of record is your seller in Canada, but you're still the entity earning the income, which means CRA, the Canada Revenue Agency, has the right to look at your books. And here's the kicker. None of your merchant of record services negate your corporate tax filing obligations, nor do the services of your merchant of record negate your treaty obligations. The merchant of record only handles sales tax. So while you think your tax burden is being taken care of, you may actually be sitting on unfiled Canadian tax returns with penalties mounting in the background.